You're sitting there right now thinking you understand money. You've got a savings account, maybe some investments. You read the headlines, follow the trends, feel like you're doing okay. But here's the truth nobody wants to admit. Most of us are one market crash away from panic, one bad decision away from years of regret. We're not investing, we're guessing, we're hoping. We're crossing our fingers and pretending confidence is the same thing as competence. What's up, book lovers? Welcome to Book Zeal. Today we're diving into The Intelligent Investor by Benjamin Graham, the book that literally created the blueprint for every successful investor who followed. We're covering the 10 most critical chapters that separate people who build lasting wealth from people who chase dreams and lose money. You're going to learn the real difference between investing and gambling with fancy terminology, how to handle market crashes without losing your mind, why inflation is stealing your future while you sleep, the exact formulas both defensive and aggressive investors need, how companies lie with numbers and how to catch them, and the one concept that protects you when everything goes wrong. Skip the chapter on margin of safety, and you'll spend decades learning expensive lessons the hard way. Miss the part about market fluctuations and you'll panic sell at every dip. This isn't theory, this is survival. So let's get started. Chapter 1. Investment versus speculation. You know that feeling when you're scrolling through your phone at 2 in the morning and you see someone your age just bought their 3rd rental property? Yeah, that one. The pit in your stomach that whispers you're falling behind in some invisible race you didn't even know you were running. Here's the thing, nobody tells you. That person might not be winning anything. They might be gambling. And you? You might actually be ahead without even knowing it. Benjamin Graham wrote The Intelligent Investor in 1949, and somehow this guy predicted every stupid financial decision we'd make 75 years later. He saw us coming from a mile away. The difference between investing and speculating isn't just some boring textbook definition. It's the difference between building a life and betting on one. Think about it like this. There's a street vendor in Mumbai who saves 15% of everything he makes. Rain or shine, wedding season or monsoon. He doesn't check stock prices. He doesn't have a trading app that sends him notifications at 3 in the morning. He just saves, invests in government bonds. Nothing flashy. Meanwhile, his neighbor, a software engineer making 10 times his income, is up at midnight watching crypto charts like they're a heartbeat monitor in an emergency room. Fast forward 20 years. Guess who sleeps better? Graham saw this pattern everywhere. He watched the market crash in 1929, saw fortunes evaporate like morning fog. Not because people were stupid, but because they confused motion with progress. They confused activity with achievement. They thought if they were doing something, anything, they were winning. Speculation feels like investing the same way a sugar rush feels like energy. For about 20 minutes, you're flying. You're a genius. You're telling everyone at dinner about your moves. Then comes the crash. And it's not just your portfolio that crashes. It's your confidence, your sleep, your ability to think about anything else. Investment is different. Investment is boring. And that's exactly why it works. Graham defined an investment operation as one which, upon thorough analysis, promises safety of principal and an adequate return. Everything else? That's speculation. Notice he didn't say massive returns. He didn't say get rich quick. He said adequate. Because adequate compounds. Adequate doesn't keep you up at night. Adequate lets you live your actual life instead of constantly monitoring some numbers on a screen. There's this moment in the book where Graham talks about how the speculator's primary interest is in anticipating and profiting from market fluctuations. The investor's primary interest is in acquiring and holding suitable securities at suitable prices. Read that again. The speculator is trying to predict the unpredictable. The investor is just trying to buy good things when they're reasonably priced. It's like the difference between trying to predict which song will go viral next week versus just enjoying music. One turns you into an anxious mess, constantly refreshing social media. The other actually enriches your life. And here's where it gets real. Most of us think we're investors when we're actually speculators. We tell ourselves we're building wealth when we're really just feeding an addiction to action, to feeling like we're doing something. Chapter 2. The Investor and Market Fluctuations. The market dropped 300 points yesterday, and somewhere right now someone is staring at their phone, wondering if they should sell everything. Their hand is literally shaking, heart racing. That retirement account they haven't touched in 5 years suddenly feels like a ticking bomb. Graham would look at that person and probably sigh, because this exact panic has happened 1,000 times before. Different decade, different crisis, same human behavior. Picture this. It's 1973. The stock market is tanking. Everyone's losing their minds. There's this guy, let's call him Robert, who works at an insurance company in Cleveland. Nothing fancy. He's been putting money into index funds for 8 years. Just clockwork. Every paycheck. Same amount. Never thinks about it. Then his brother-in-law shows up at Thanksgiving dinner, talking about how he just pulled all his money out because he's not an idiot, and only idiots stay in a falling market. Robert goes home that night and can't sleep. Opens his brokerage account, sees red numbers everywhere. His stomach drops. For the first time in 8 years, he's actually looking at the daily movements, and it's terrifying. Here's what Graham understood that most people miss. The market isn't there to instruct you. It's there to serve you. But we get it backwards. We treat market prices like they're verdicts on our intelligence, like they're report cards, like they mean something about us personally. They don't. Market fluctuations are just noise. They're the crowd having feelings. And crowds have terrible feelings. Crowds panic. Crowds get euphoric. Crowds are basically toddlers with money. Would you let a toddler tell you what your house is worth? No? Then why are you letting the market tell you what your investments are worth every single day? There's a reason Graham called it Mr. Market. He personified it, gave it a character. Imagine you own a small business with this partner named Mr. Market. Every single day, without fail, this guy shows up at your door with an offer. Some days he's wildly optimistic and offers you triple what your share is worth. Other days he's depressed and offers you half. You can take his offer or ignore him completely. He doesn't care. He'll be back tomorrow with a new price. Now here's the beautiful part. You don't have to do anything. You can just let him stand there. But most people can't handle that. Most people see Mr. Market getting excited and think they're missing something. Or they see him getting depressed and panic that he knows something they don't. He doesn't know anything. He's just having feelings. Graham watched investors destroy themselves not because they picked bad companies, but because they couldn't handle the emotional roller coaster of price movements. They bought solid businesses at fair prices, then sold them at terrible prices just because watching the numbers go down felt unbearable. Think about the absolute absurdity of this. You wouldn't sell your car for half price just because your neighbor said cars are worthless this week. You wouldn't sell your house at a loss because someone on the news said real estate is doomed. But with stocks, we do it constantly. We let other people's panic become our reality. Robert from Cleveland didn't sell in 1973. Want to know why? His wife literally hid the brokerage statements, stuck them in a drawer, told him they weren't looking at them anymore. It drove him crazy for about 2 weeks. Then he forgot about it, went back to his life, kept making his automatic contributions. 10 years later, he opened that drawer. He'd quadrupled his money, not because he was smart, because he was protected from his own fear. The market recovered. It always does. But the people who sold during the panic, they locked in their losses, turned temporary drops into permanent destruction. Graham saw this pattern repeat endlessly. Different generation, same mistake. Chapter 3. The Investor and Inflation. Your grandmother could buy a movie ticket for a quarter. You can barely buy a candy bar for that now, and yet somehow we're all walking around pretending this isn't slowly stealing our future. Inflation is the silent thief that nobody wants to talk about at parties. It doesn't break into your house. It doesn't hack your bank account. It just sits there, quietly eroding everything you've saved, while you watch Netflix and think you're doing fine because your savings account balance looks the same as it did last year. Spoiler alert, it's not the same, not even close. Graham wrote about this in the 1970s when inflation was ripping through the economy like a forest fire. But here's the scary part. He predicted our exact situation decades before we'd live it. He knew that most people would handle inflation the exact same way they handle a slow leak in their tire. They'd notice something felt off, shrug, and keep driving until the whole thing exploded. There's this couple in Seattle, mid-30s. Both have decent jobs. They've got about $50,000 sitting in a savings account, earning maybe 0.5% interest. They feel responsible. They feel smart. They've got their emergency fund. They're adulting. Meanwhile, inflation is running at 4%, which means every single year they're effectively losing 3.5% of that money's purchasing power. In 10 years, that $50,000 will buy what $35,000 buys today. They didn't spend it. They didn't lose it in some scam. They just let it sit there, and inflation ate it alive. Graham called this the cruelest tax, because it is. It hits everyone, it never takes a day off, and it's completely invisible until you try to buy something and realize your money doesn't stretch like it used to. Remember when your parents told you they bought their house for $70,000 and you thought they were living in some golden age? They were. Not because wages were better relative to costs, but because the dollar actually meant something. A dollar in 1970 had the purchasing power of about $7 today. Let that sink in. Your money loses value just by existing. And here's where most financial advice falls apart. Everyone tells you to save, build that emergency fund, sock money away. All good advice, but nobody mentions that saving cash is like storing ice cream in your garage in July. Sure, it's still technically there, but it's melting, getting smaller, turning into something less useful with every passing hour. Graham's solution wasn't complicated. He didn't tell people to panic or speculate or try to time inflation cycles. He just said own real assets. Own pieces of actual businesses that can raise their prices when costs go up. Own things that produce value in the real world. Think about it. If you own shares in a company that makes soap, and inflation drives up the cost of ingredients, what does that company do? It raises the price of soap. Your investment adjusts. It protects itself. But your savings account? It just sits there taking the hit. There was this study done following families over 40 years. 2 families, same income, same savings rate. Family 1 kept everything in savings accounts and bonds. Safe, secure, predictable. Family 2 put half their savings into stocks. The difference after 4 decades? Family 2 had nearly 4 times the purchasing power. Not because they were geniuses, not because they took crazy risks, just because they understood that inflation doesn't care about your feelings or your need for safety. It's going to eat your lunch either way. The weird thing about inflation is how it makes cowards of us all. We're so scared of market crashes that we hide in cash. But we're not scared of the guaranteed loss that inflation delivers every single year. We can see a market crash. It's dramatic. It's on the news. But inflation? It's like gaining a pound a month. You don't notice it happening until suddenly none of your clothes fit, and you're wondering how you got here. Graham watched retirees in the 70s get absolutely destroyed. They'd saved their whole lives, done everything right according to the old rules, kept their money in government bonds paying 5%, felt safe. Then inflation hit double digits, and suddenly they were getting poorer every month while technically earning interest. Chapter 4. General Portfolio Policy. The Defensive Investor. Most people want to get rich. Graham wanted you to not get poor, and somehow that second goal is way harder to achieve. There's something almost insulting about the term defensive investor. It sounds passive. It sounds like giving up. Like you're the person at the party standing in the corner while everyone else is dancing. But Graham knew something that most people spend their entire lives learning the hard way. The person who doesn't lose usually ends up ahead of the person trying to win big. A woman in Austin spent 20 years working as a school librarian, never made more than $45,000 a year, retired at 65 with more money than her friend, who'd been a corporate lawyer making 6 figures. How? She split everything down the middle. 50% stocks, 50% bonds, rebalanced once a year. That's it. No genius moves, no hot tips, no staying up late reading market analysis. Her lawyer friend? Different story. He was enterprising. He was active. He picked individual stocks, traded options, got excited about tech startups, had wins that made him feel brilliant and losses that made him feel sick. Spent 20 years on an emotional roller coaster that ultimately took him nowhere. The defensive investor isn't defensive because they're scared. They're defensive because they understand that investing isn't a game you win. It's a game you don't lose, and not losing requires a completely different strategy than most people think. Graham's formula was almost boring in its simplicity. Never less than 25% in stocks. Never more than 75%. Never less than 25% in bonds. Never more than 75%. Adjust based on your age and your ability to sleep at night. That's the whole strategy. You could write it on a napkin. But here's why it works. When stocks are soaring and everyone's getting rich and you feel like an idiot for having money in bonds, those bonds are your anchor. They're keeping you from doing something stupid like putting everything into whatever's hot right now. And when the market crashes and everyone's panicking and your stocks are down 30%, those bonds are still there, still paying, still stable, giving you the courage to not sell at the bottom. It's like having a friend at the bar who stays sober, not because they're judging you, just because someone needs to drive home. The whole concept feels wrong to our brains, though. We're wired to go all in on what's working. When stocks are up, we want more stocks. When bonds are paying well, we want more bonds. We chase performance like dogs chasing cars, never quite catching anything, just running ourselves ragged. Graham watched this happen in every market cycle. People would come to him excited about some opportunity, some sector that was exploding, some trend that couldn't miss. And he'd ask them one question: "What's your allocation?" They'd look at him confused. Allocation? They wanted to talk about opportunities, about potential, about getting in early. He didn't care. Because he knew opportunities mean nothing if you don't have a system to prevent you from blowing up your entire life when you're wrong. Think about a tightrope walker. They're not thinking about style points. They're thinking about balance. One side gets too heavy, they shift. The other side dips, they compensate. It's not exciting. It's not sexy, but it's what keeps them from falling. There's this guy who posts his portfolio on social media every year. Same thing, 50-50 split, stocks and bonds. The comments are always brutal. People calling him boring, asking why he doesn't have crypto, why he's not in AI stocks, why he's wasting his potential. He never responds, just posts his returns, year after year, beating most of the people making fun of him. Because here's what Graham understood. The defensive investor's goal isn't to beat the market. It's to match the market with way less stress and way less chance of catastrophic loss. It's to be able to ignore the news, to not care what some talking head on television thinks about tomorrow, to actually live your life instead of constantly managing your anxiety about money. The rebalancing part is where the magic happens, though. Once a year, you look at your portfolio. If stocks have done well and now represent 70% instead of 50%, you sell some stocks and buy bonds. Feels crazy, right? Selling winners to buy the thing that didn't perform as well? But that's exactly the discipline that saves you. You're forcing yourself to sell high and buy low. Not because you're trying to time anything, just because you're maintaining balance. It's mechanical, emotionless, the opposite of how humans naturally behave. Chapter 5. Portfolio Policy for the Enterprising Investor. So you think you're special. You think you're the one who can beat the system. You've read the articles, watched the YouTube videos. You understand PE ratios and market caps, and you're ready to crush it. Graham would look you dead in the eye and ask one question. How much time do you actually have? Not how much time do you think you have. Not how much time you'll magically create once you start making money. How much time right now, today, can you dedicate to this without it destroying everything else in your life? The enterprising investor isn't smarter than the defensive investor. That's the first myth Graham destroys. They're not more talented. They don't have some special gene. They just have more time and they're willing to treat investing like a second job. Because that's exactly what it is. There's a dentist in Portland who decided he was going to be enterprising. Made sense in his head. He was smart. Got through dental school. Ran a successful practice. How hard could stock picking be? So he started spending his evenings analyzing companies, reading annual reports, building spreadsheets. 3 months in, his wife asked him when he'd last played with their kids. He couldn't remember. 6 months in, he'd made about 4% while the market made 7%. He was working 20 hours a week for worse returns than doing nothing. That's the trap. The enterprising approach sounds exciting. It sounds like taking control, like being active and intelligent and engaged. But it's a trap unless you're genuinely willing to put in the work. Real work. Not scrolling through stock forums while watching TV, not reading headlines and thinking you understand a company. Actual deep analysis that takes hours and skills most people don't have. Graham laid out the requirements. You need to analyze financial statements, understand business models, compare companies within industries, calculate intrinsic values, track management decisions, monitor competitive advantages. And you need to do this for multiple companies because diversification still matters. You're looking at hundreds of hours per year minimum. For what? Maybe an extra 2 or 3% return if you're disciplined and lucky. Maybe worse returns if you're not. Here's where it gets interesting, though. Graham wasn't saying, don't do it. He was saying, know what you're signing up for. The enterprising investor can win, but they win by finding opportunities the market has overlooked. Companies trading below their liquidation value. Businesses with strong fundamentals that nobody's paying attention to. Situations where you actually know something the crowd doesn't. Not because you read an article, because you did the homework. There was a guy in the 1960s who found a small regional bank trading at half its book value. Nobody cared about it. Too small, too boring, wrong location. He spent weeks analyzing their loan portfolio, visited branches, talked to customers, read every regulatory filing, calculated that even if they never grew again, the assets alone were worth double the stock price. He bought as much as he could afford. 3 years later, the bank got acquired. He made 4 times his money. That's enterprising investing. Not buying Tesla because you think electric cars are the future. That's just speculation with extra steps. Graham drew a hard line between enterprising investing and speculation. Speculation is guessing about price movements. Enterprising investing is finding genuine value that the market has missed. One requires luck and timing. The other requires work and patience. Most people who think they're enterprising investors are actually just defensive investors who haven't admitted it yet. They want the excitement of picking stocks without the boring work of analysis. They want to feel smart without earning it. So they end up in this weird middle ground where they're taking more risk than defensive investors, but without any of the potential upside of true enterprising work. Graham had this concept he called the middle-of-the-road investor. The person who's too restless to be defensive but too busy to be properly enterprising. According to him, that's the worst place to be. You get all the stress and volatility of active investing with none of the benefits. You're basically paying extra for anxiety. Think about someone training for a marathon. Either you commit to the training plan, wake up early, track your miles, adjust your diet, or you don't run the marathon. You don't show up on race day having jogged twice in the last 6 months and expect to finish strong. But that's exactly what most enterprising investors do. They show up to compete against professionals and dedicated amateurs having done maybe 5% of the preparation. The market doesn't grade on a curve. It doesn't care that you have a demanding job or kids or a social life. It rewards the people who do the actual work. Everyone else, they're just donating money to the people who did. Graham's advice for the enterprising investor was almost harsh in its honesty. Either commit completely or just be defensive. There's no shame in the defensive approach. It works. It's proven. It lets you live your life. But if you're going to be enterprising, be actually enterprising. Not Instagram enterprising where you post screenshots of your portfolio. Real enterprising where you're reading 10Ks at midnight and building valuation models on weekends. Chapter 6. Stock Selection for the Defensive Investor. You know what's hilarious? Most people spend more time choosing a restaurant for dinner than they do choosing stocks they'll hold for 10 years. Graham knew this about human nature. We're terrible at important decisions. We get paralyzed. We overthink. We ask 17 people for advice and then do whatever feels right in our gut, which, spoiler alert, is usually the worst possible option. So he created a checklist. 7 rules. That's it. Follow them, and you'll avoid most of the catastrophic mistakes that turn investors into cautionary tales. Ignore them, and you're basically playing financial Russian roulette, hoping you're special enough to survive. Rule 1. Adequate size. Don't buy tiny companies. Graham said, avoid anything that's not substantial. Why? Because small companies disappear. They get crushed by competitors. They run out of money. They're exciting right up until they're gone. You want boring companies that have been around long enough to survive recessions. Companies that aren't going anywhere because they're already everywhere. A teacher in Minnesota ignored this rule. Found this small tech startup that was going to revolutionize something. Put $20,000 into it. Felt like a genius for about 6 months. The stock tripled. He told everyone at school. Thought about early retirement. Then the company burned through their cash, couldn't raise more funding, and shut down. His $20,000 became zero. Not zero profit. Zero. The whole thing vanished. Meanwhile, his colleague bought shares in a massive consumer goods company that makes everything from toothpaste to laundry detergent. Boring as dirt. That investment is still there 20 years later. Still paying dividends. Still existing. Rule 2. Strong financial condition. Current assets should be at least twice current liabilities. And long-term debt shouldn't be more than working capital. This sounds technical, but it's actually simple. Can this company pay its bills? Does it have a cushion? Or is it one bad quarter away from disaster? Think about it like personal finance. Would you trust someone who makes $5,000 a month but has $6,000 in monthly expenses and $20,000 in credit card debt? No. You'd know that person is a crisis waiting to happen. Same with companies. If their finances are held together with duct tape and hope, they're not defensive investments. They're lottery tickets. Rule 3. Earnings stability. Positive earnings in each of the past 10 years. Not most years. Not 7 out of 10. Every single year. Because if a company can't figure out how to make money consistently for a decade, what makes you think they'll suddenly get good at it right after you buy their stock? There's this fashion retailer that had amazing years when trends went their way, and terrible years when they didn't. Up and down like a yo-yo. People kept buying the stock during the up years thinking they'd figured something out. They hadn't. They were just riding trends. The company is bankrupt now. Closed all their stores. Shareholders got nothing. Compare that to a utility company. Makes money every year. Has to. People need electricity whether the economy is booming or collapsing. Boring? Absolutely. Bankrupt? Never. Rule 4. Dividend record. Some dividend payment in each of the past 20 years. This is Graham basically saying, show me you're not just making money on paper. Show me you're actually generating cash and sharing it. Companies that pay dividends consistently are companies that have their act together. It's like the difference between someone who says they're successful and someone who actually pays their rent on time. Talk is cheap. Dividends are proof. Rule 5. Earnings growth. At least a 1/3 increase in earnings per share over the past 10 years. Notice he didn't say triple. He didn't say explosive growth. He said 1/3 over 10 years. That's about 3% annually. He's not asking for miracles, just steady improvement. Proof the company is moving forward, not treading water. A pharmaceutical company met every other rule on Graham's list. Solid finances, paid dividends, consistent earnings. But when you looked close, their earnings had been flat for 12 years. Same profit in year 12 as year 1. That's not stability, that's stagnation. And stagnation becomes decline faster than most people realize. Graham would skip it. Too many better options out there. Rule 6. Moderate price-to-earnings ratio. Don't pay more than 15 times average earnings of the past 3 years. This is Graham telling you not to get caught up in hype. Don't buy something just because it's popular. Don't pay 50 times earnings because everyone's excited. That's not investing. That's hoping someone more foolish than you comes along to buy it for even more. The late 90s were filled with people buying internet stocks at ridiculous valuations. Companies with no profits trading at prices that made no mathematical sense. People justified it with stories about the future, about potential, about new paradigms. Then reality showed up and those stocks dropped 90%. Some disappeared completely. Rule 7. Moderate price-to-book ratio. Price should not be more than 1.5 times book value. Basically, don't pay way more for a company than its actual assets are worth. You're buying a business, not a dream. These 7 rules eliminate probably 95% of available stocks. And that's exactly the point. Chapter 7. Stock selection for the enterprising investor. Remember that dentist from Portland who thought he could pick stocks in his spare time? This chapter is where he realizes he was never actually enterprising. He was just defensive with delusions of grandeur. The enterprising investor has to hunt, not browse, not scroll through popular stocks and hope. Actually hunt for opportunities that don't announce themselves with fireworks and CNBC appearances. Graham broke it down into 3 approaches. And here's the thing, none of them involve buying whatever stock your coworker won't shut up about. First approach, buy large companies when they're temporarily unpopular. Notice the word temporarily, not permanently broken, not fraudulent, not dying industries. Just good companies that everyone's mad at right now for reasons that probably won't matter in 5 years. There was this massive retailer in the early 2010s. Been around forever. Solid business. Then they had one bad quarter. Missed earnings estimates by a tiny amount. The stock dropped 30% in a week. Analysts downgraded it. Articles proclaimed the death of brick-and-mortar retail. Panic everywhere. An enterprising investor looked at the fundamentals. The company still had great locations, strong cash flow, no debt problems, just one mediocre quarter that sent everyone running. She bought in heavy, held for 3 years. The company figured out their supply chain issues. Stock recovered, and then some. She more than doubled her money, not because she predicted the future, because she found value where everyone else saw disaster. That's the game, finding the difference between a company having a bad day and a company that's actually doomed. Most people can't tell the difference. They see red numbers and panic. They see negative headlines and assume it's over. The enterprising investor asks better questions. Is the core business still sound? Are the problems fixable? Is the market overreacting? Usually, the market is absolutely overreacting. Second approach. Buy secondary companies at bargain prices. These are solid businesses that nobody's excited about. They're not growing explosively. They're not sexy. They don't get mentioned in trend pieces. They just exist, make money, and trade at prices that don't make sense. Graham called these the neglected stocks. Wall Street ignores them because there's no story to sell, no growth narrative, no revolutionary technology. Just boring companies doing boring things profitably, which means they often trade way below their actual value simply because nobody's paying attention. Think of a small regional insurance company. Not Geico, not State Farm, something you've never heard of operating in 3 states. They've been profitable for 40 years, pay dividends, have minimal debt, but their stock trades at 8 times earnings because no analyst covers them. No institutional investors care. No momentum traders know they exist. An enterprising investor finds that company, does the analysis, realizes they're buying $1 for 50 cents, buys a meaningful position, waits, eventually someone else notices, or the company gets acquired, or the market just wakes up. Doesn't matter. The value was always there. The price just had to catch up. This requires patience, though. Real patience. Not "I'll check back in a week" patience. More like "I'll check back in 3 years" patience. Most people can't handle that. They need action, need movement, need to feel like something's happening. So they miss these opportunities completely. Third approach. Special situations. Mergers, spin-offs, liquidations, reorganizations. Events where something unusual is happening that creates temporary pricing inefficiencies. When a large company spins off a division, the new shares usually get distributed to existing shareholders who don't want them and immediately sell. Creates downward pressure on price regardless of value. An enterprising investor analyzes the spun-off company. If it's actually solid, they buy while everyone's dumping. There was a major conglomerate that spun off their industrial equipment division in 2015. Shareholders were disappointed. They wanted the sexy tech parts of the business, not boring industrial equipment. The spin-off dropped 40% in the first month. Not because anything was wrong with it, just because nobody wanted it. Someone did the math. The equipment division had steady contracts, predictable revenue, strong margins. At the beaten-down price, it was trading at 6 times earnings. They bought aggressively. 2 years later, a private equity firm acquired the whole company at a massive premium. The enterprising investor tripled their money. But here's what separates real enterprising investors from pretenders. They don't just find opportunities. They size them correctly. They diversify across multiple opportunities because they know even good analysis can be wrong. They set rules for when to sell. They track their actual performance honestly, not just the winners they brag about. A guy in Chicago spent 5 years doing enterprising investing, kept detailed records, calculated his time investment. His returns beat the market by about 2% annually. Sounds great until you realize he spent an average of 15 hours per week on research and analysis. That's almost 800 hours per year. He was essentially working a part-time job for an extra 2%. He went back to being a defensive investor, not because he failed, because he succeeded just enough to realize it wasn't worth the life he was giving up. That's the honest truth about enterprising investing. It can work, but it demands more than most people want to give. More time, more skill, more emotional discipline, more willingness to be wrong and learn from it, more capacity to watch everyone else get excited about popular stocks while you're digging through financial statements of companies nobody's heard of. Chapter 8. Security Analysis for the Lay Investor. Your eyes glaze over the second someone mentions balance sheets. Totally normal. Most people's do, even people who own stocks, especially people who own stocks. Graham spent his whole career teaching security analysis, written entire textbooks on it. Then he wrote this chapter, basically admitting that most people will never do it properly. And that's okay, as long as they know what they don't know. The dangerous investor isn't the one who admits they can't analyze a balance sheet. It's the one who thinks Googling a company's PE ratio makes them an analyst. Here's what actually matters. A woman in Phoenix inherited $50,000 from her uncle. Her broker immediately started pitching her individual stocks. Technology companies with exciting stories, growth narratives, disruption potential, all the buzzwords. She asked one question: how do I know if these companies are actually worth what you're saying they're worth? He got irritated. Started explaining metrics she didn't understand. Threw around terms like EBITDA and enterprise value. Made her feel stupid for asking, so she walked out. Found a different advisor who said something radical. You don't need to analyze anything. Buy index funds. Go live your life. She did exactly that. 10 years later, she'd more than doubled her money. Her broker's hand-picked portfolio? 3 of the 5 companies he recommended no longer exist. Graham knew that security analysis is a skill that takes years to develop. You can't learn it from a weekend seminar or a YouTube video. You need to understand accounting, business operations, industry dynamics, competitive positioning, management quality, and even then, you're going to be wrong a lot. But he also knew people want to feel involved, want to feel smart, want to believe they're making informed decisions. So he gave them a framework, not for picking winners, for avoiding disasters. First thing, bond analysis. If you're buying bonds, you need to know one thing. Can this entity pay you back? That's it. Not will their business grow. Not do they have exciting prospects. Just can they pay their debts? Graham said, look at earnings coverage. How many times over do their earnings cover their interest payments? If a company earns $10 million and owes $2 million in interest, that's 5 times coverage. Comfortable. If they earn $10 million and owe $9 million in interest, that's terrifying. One bad year and they default. There's this concept called margin of safety that runs through everything Graham teaches. Don't buy bonds from companies skating on thin ice. Don't buy them from municipalities drowning in debt. Buy from borrowers who could have a terrible year and still pay you easily. A county in California issued bonds in the early 2000s. Looked fine on paper. Then the financial crisis hit. Their tax revenue collapsed. They'd been counting on property taxes that evaporated when home values crashed. Bondholders took massive losses. Could have been avoided by anyone who bothered asking what happens if property values drop 30%. Nobody asked. Everyone assumed good times last forever. They never do. Stock analysis is trickier because you're not just asking, can they pay me? You're asking, is this business worth owning at this price? Graham said focus on 2 things: earnings power and asset value. Earnings power means, can this company consistently generate profit? Not one amazing year followed by 3 disasters. Consistent, reliable profit that you can count on. Look back 10 years. If earnings are all over the place, that's not a business. That's a gamble. Asset value means what's actually here. Strip away the story. Ignore the hype. What does this company own? What's it worth? If they shut down tomorrow and sold everything, what would shareholders get? Most investors completely ignore asset value. They buy stories, buy potential, buy dreams, then act shocked when companies with no real assets go bankrupt and shareholders get nothing. A software company in 2008 had a market value of $2 billion. Exciting product, great marketing, everyone loved them. Then someone actually looked at their balance sheet. They had about $50 million in actual assets, mostly office furniture and computers. The rest was goodwill and intangible assets, accounting fiction. When the business struggled, that $2 billion evaporated because there was nothing actually there. Compare that to a manufacturing company worth $2 billion that owns factories, equipment, inventory, and real estate worth $1.5 billion. Even if the business fails, there's real value to recover. That's the difference between investing and speculation. Graham also warned about one of the sneakiest problems in analysis: overpaying for growth. Companies that are growing fast get valued, like they'll grow fast forever. They won't. Growth slows. Competition emerges. Markets saturate. But investors pay 50 times earnings assuming nothing will change. Then something changes. Always does. And the stock collapses not because the company failed, but because it stopped being miraculous and became merely good. A retailer in the 90s was opening new stores every quarter. Stock kept climbing. Analysts loved them. Then they ran out of good locations. Growth slowed from 30% annually to 5%. Still profitable, still successful, still opening stores. But the stock dropped 60% because they were no longer magical. People who bought at the peak lost money on a company that was actually doing fine. That's what happens when you pay for perfection. Here's Graham's honest advice for the lay investor. You probably can't do meaningful security analysis. That's not an insult. Most professional analysts can't either. They just hide behind jargon and confidence. What you can do is stay within your circle of competence. Only invest in businesses you genuinely understand. Not understand the stock chart. Understand the actual business. How they make money. Who their customers are. What could go wrong? If you can't explain a company's business model to a 12-year-old, you don't understand it well enough to own it. Chapter 9. Things to consider about per-share earnings. Earnings per share. 3 words that sound simple and objective, like a fact, like something you can trust. Except, companies have figured out about 17 different ways to lie to you using technically legal accounting. Graham saw this coming decades ago, watched companies play games with numbers, watched investors fall for it every single time. The games got more sophisticated. The investors stayed just as gullible. Here's the setup. You're comparing 2 companies. Both report earnings per share of $5. Both trade at 15 times earnings. They look identical on paper. You flip a coin and buy one. 5 years later, one company has tripled. The other is bankrupt. What happened? The earnings weren't actually the same. One was real. One was creative accounting dressed up to look real. There's a tech company that reported growing earnings for 8 straight quarters. Stock kept climbing. Investors were thrilled. Then someone actually read the footnotes in their financial statements. Turns out they were capitalizing regular business expenses, treating normal costs as investments, made their current earnings look better by pushing expenses into the future. Eventually, the future arrived. They couldn't hide it anymore. The real numbers came out. Earnings had actually been declining the whole time. Stock dropped 70% in a month. Class action lawsuits, executive resignations, the whole disaster. But here's the thing, it was all legal. Aggressive, but legal. The information was there in the filings, just buried, hidden in footnotes and technical language. Most investors never looked. They saw the headline number and trusted it. Graham said, treat reported earnings like you'd treat someone's dating profile, probably based on truth, definitely showing the best angle, possibly hiding major problems. First red flag. One-time gains. A company sells a building and books a massive profit. Their earnings spike. Looks amazing, except it's not recurring. They can't sell that building again next year. But the earnings per share number treats it like normal business income. Makes the company look more profitable than it actually is. A manufacturing company did this in 2016. Sold some real estate they'd owned forever. Booked a $50 million gain. Their earnings per share jumped from $2 to $4. Stock popped. Investors thought something amazing was happening with the core business. Nothing had changed. They just sold a building. Next year, earnings went back to $2. Stock gave back all the gains. Anyone paying attention could have seen it. The footnotes explained exactly what happened. But most investors don't read footnotes. They read headlines, second red flag, share buybacks masking problems, company earnings are flat, $20 million this year, $20 million last year, but they bought back 10% of their shares. Now that same $20 million gets divided among fewer shares. Earnings per share goes up, even though the business didn't actually improve. Wall Street celebrates this. Analysts raise price targets. Nobody asks why the company is buying back shares instead of investing in growth. Nobody wonders if management is just gaming metrics to hit bonus targets. A retail chain did this for 3 years straight. Kept buying back shares. Earnings per share kept rising. Stock kept climbing. Then they ran out of cash for buybacks. The real performance became visible. Sales were declining. Margins were shrinking. The business was slowly dying. They'd just hidden it by making the denominator smaller. 3 years later, they filed for bankruptcy protection. Shareholders lost everything. The executives who orchestrated the buybacks, they'd already cashed out their stock options at inflated prices. Third red flag: pension assumptions. Companies with pension plans make assumptions about future returns. Assume they'll earn 8% annually on pension investments. That assumption affects how much they need to contribute now, which affects reported earnings. If they're unrealistic with assumptions, they understate pension obligations, overstate current earnings, push problems into the future. By the time reality catches up, the executives who made those decisions are long gone. A major airline did this for years. Assumed their pension fund would generate returns that were basically impossible, contributed less than they should have, reported better earnings than they actually had. Eventually, the pension became massively underfunded. They had to make enormous catch-up contributions, crushed their finances for years. Investors who trusted the reported earnings got destroyed. The earnings were never real, just accounting optimism that eventually collided with math. Graham's advice was to look at average earnings over multiple years, smooths out the spikes and dips. One great year might be luck. 5 consecutive solid years is a real business. Also, ignore one-time items completely. Strip them out. Focus on what the company earns from actually operating their business year after year. He also said, pay attention to the quality of earnings, not just the quantity. Are earnings coming from sales growth? That's high quality. Are they coming from cutting costs to the bone? That's temporary. Are they coming from accounting tricks? That's fiction. A pharmaceutical company reported steady earnings growth. Looked great. Then you noticed their revenue was flat. They weren't selling more. They were just squeezing more profit from the same sales, cutting research and development, delaying maintenance, reducing quality control. All things that boost short-term earnings but destroy long-term value. Sure enough, 3 years later they had major product recalls, fell behind in drug development, lost market share to competitors who'd been investing in the future. The short-term earnings boost became long-term disaster. Another trick: changing depreciation schedules. A company owns equipment that wears out. They need to expense that wear and tear. But they have flexibility in how fast. Slow down depreciation and current earnings look better. Speed it up and earnings look worse. Same physical reality, different numbers. Graham watched companies extend asset lives right before selling stock to the public. Made earnings look great, attracted investors. Then, after the sale, they'd adjust back to realistic depreciation. Earnings would drop. New shareholders would lose money. Old shareholders and executives had already cashed out. The game never changes, just the specifics. Here's what matters. Don't trust any single year's earnings. Don't trust headline numbers without reading the details. Don't assume companies are giving you straight information just because it's in an official filing. They're giving you the most favorable legal interpretation of reality. Your job as an investor is to find the actual reality hiding underneath. Chapter 10: Margin of Safety as the Central Concept of Investment. Everything Graham taught you for the last 9 chapters boils down to 3 words: margin of safety. Miss this and nothing else matters. Get this, and most other mistakes become survivable. Think about a bridge. Engineers don't design it to hold exactly the weight it'll carry. They design it to hold 3 times that weight, 4 times, 5 times, because they know their calculations might be off. Materials might be weaker than expected. Conditions might be worse than predicted. The margin of safety is what keeps the bridge standing when reality doesn't match the blueprint. Investing works the same way, except most people build bridges that collapse if one extra car drives across. A couple in Denver analyzed a stock, calculated its intrinsic value at $50 per share. Looked solid, strong business, good fundamentals. Then they bought it at $49. Felt smart, felt like they'd found a deal. Got $1 of margin, $1 between them and being wrong. 6 months later, the company was fine, business performing as expected, but the market decided to value it differently. Stock dropped to $40. They panicked, sold at a loss. Not because the business failed, because their margin of safety was a joke. $1 doesn't protect you from anything. Graham would have told them to wait for 35, maybe 30. Buy that same $50 value at a 40% discount. Now you've got real protection. Now the company can disappoint and you're still fine. The business can perform worse than expected and you still make money. That's what margin of safety means. Room to be wrong without getting destroyed. Here's the brutal part. Most investment advice ignores this completely. They tell you to buy great companies, find growth stocks, invest in the future, all of which sounds smart until you realize they never mention price. Like price doesn't matter. Like you can pay anything for a good company and be fine. You can't. The best company in the world is a terrible investment at the wrong price, and a mediocre company can be a great investment at the right price. This isn't complicated, but somehow everyone forgets it the second they get excited about something. During the dot-com bubble, there was this internet company, actually had revenue, actually had customers, actually had a real business. Unlike most of the junk trading at the time, people pointed to it as proof that valuations made sense. Look, a real company with real earnings. It was trading at 150 times earnings. For that price to make sense, they'd need to grow earnings by 30% annually for 15 years straight. Without stumbling, without competition, without any of the 1,000 things that normally go wrong. They grew for 3 years. Then growth slowed. Stock collapsed. Lost 90% of its value. The business survived. Still exists today. Still profitable. But investors who bought at the peak never recovered. They bought a good company with zero margin of safety. When it turned out the company was merely good instead of miraculous, they got slaughtered. Meanwhile, boring companies trading at 8 times earnings barely noticed the crash because they had massive margins of safety built in. They could miss expectations, have bad years, struggle with problems. Stock would dip, but shareholders would be fine. The margin absorbed the mistakes. Graham separated investing from speculation using this exact concept. If you have a margin of safety, you're investing. If you don't, you're speculating. Doesn't matter what you're buying. Doesn't matter how sophisticated your analysis is. Without that buffer, you're just gambling with extra steps. Think about buying a house. You get it appraised at $300,000. Would you pay $300,000? Maybe. Would you pay $350,000? Probably not. You want it for $260,000, $270,000. Room for the appraisal to be optimistic. Room for repairs you didn't see. Room for the market to shift. Room for life to happen. Same logic applies to stocks. Except people forget it constantly. They see a company they love and pay whatever. Justify any price with stories about the future. Then wonder why they lose money when the future turns out different than they imagined. A woman in Philadelphia spent 5 years analyzing companies, built detailed models, calculated intrinsic values down to the penny. Her accuracy was actually impressive. She'd estimate a company was worth $43 and it would trade to $45 within a year. She should have made a fortune. She didn't. She broke even. Sometimes lost money, Why? Because she bought at $42. Her margin of safety was $1 or $2. Whenever her analysis was even slightly wrong, or the market took longer to recognize value, or anything unexpected happened, she'd lose money. Finally, someone told her about Graham's approach. Same analysis, same companies. But don't buy until you can get them at $30. Wait for fear. Wait for panic. Wait for the market to give you a real discount. Her results transformed, not because her analysis improved, because she built in protection. The margin of safety does something else too. It removes emotion. When you own something you bought with a huge margin of safety, market drops don't scare you. You know what it's worth. You know you paid way less. Volatility becomes opportunity instead of terror. You can think clearly when everyone else is panicking. But when you own something you paid full price for, or worse, overpaid for, every drop feels like disaster. You're constantly stressed, constantly wondering if you made a mistake. That stress leads to bad decisions, selling at bottoms, buying at tops, the exact opposite of what works. Graham watched investors torture themselves for decades. Smart people, educated people, people who understood businesses and could analyze financial statements. They'd do everything right except leave room for error. Then error would show up, like it always does, and destroy them. He'd ask them one question: "What's your margin of safety?" They'd stare at him, confused. Margin of safety? They had projections, models, thesis papers about why this investment made sense, but no margin, no buffer, no protection for being wrong. That's the difference between someone who survives markets long-term and someone who blows up. Not intelligence, not education, not access to information, just the discipline to only invest when you're getting a meaningful discount to value. There's no magic number. Depends on how certain you are, how stable the business is, how predictable the earnings are. A utility company with 90 years of steady profits, maybe 20% margin is enough. A tech startup? You'd want 70%, maybe more. The less certain you are, the bigger the margin you need. Most people do the opposite. They demand huge margins of safety for things they understand and accept tiny margins for things they don't. Buy stable companies at fair prices and speculative companies at premium prices. Exactly backwards. Graham's final point about margin of safety. It's not just about price versus value. It's also about diversification. Don't bet everything on being right about one company. Spread it around. Even with great analysis and wonderful prices, things go wrong. Companies fail. Industries collapse. Stuff you couldn't predict happens. Diversification is another form of margin of safety. Not instead of buying at good prices. In addition to, you buy multiple companies at discounts. Now, even if 2 or 3 blow up, you're still fine. The margin protects you from individual disasters. A guy in Texas followed Graham's approach perfectly for one company. Found it trading way below intrinsic value. Did thorough analysis. Had a 40% margin of safety. Then put 70% of his money into it. The analysis was right. The margin was real. The company was genuinely undervalued. Then there was an accounting fraud. Executives had been cooking the books. Company went bankrupt. His margin of safety meant nothing. His concentration destroyed him. Should have had 10 positions, not 1. Should have protected against the unknowable, not just the uncertain. That's what margin of safety really means. Protection against surprises, against being wrong, against bad luck, against a world that doesn't care about your analysis or your plans or your retirement dreams. You build in so much cushion that even when life hits you, you're still standing. So here's the honest summary of everything Graham taught. Buy good things cheap. Buy more than one. Wait for real discounts. Don't get clever. Don't get greedy. Don't confuse a bull market with genius. And never, ever buy something without leaving massive room to be wrong. Because you will be wrong. Everyone is. The investors who survive aren't the ones who are never wrong. They're the ones who built bridges strong enough that being wrong doesn't matter. That's margin of safety. That's the whole game. Everything else is just details. If you found yourself nodding along to any of this, if something clicked, if you felt that little spark of recognition, like maybe money doesn't have to be this terrifying, complicated mystery, do me a favor. Hit that like button. Not for me, for yourself. Bookmark this moment where investing started making sense. Drop a comment about which concept hit hardest. Was it the bridge analogy? The dot-com disaster? The Texas guy who concentrated everything? Share it. And subscribe, because understanding one book won't change your life, but understanding principles that work across decades just might. Graham gave us the blueprint. Now we just have to build something that lasts.